All right, everybody, welcome back to the HPT live webinar breaking down week ending 9/26/2025. This has been a really good week, and what makes it even better was how challenging last week was, and the week before that. And this is the thing, the market don't care about any of our feelings. The market doesn't care if we are making money, losing money, watching it, not watching it. The market is going to operate the way the market operates. It has its own orders of operation, regardless of how we feel about it. So what I'm looking forward to discussing in today's webinar are a few topics. Number one is going to be the 20 EMA. Okay, the 20 EMA is a phenomenal tool that we use to identify opportunity. Because I always like bringing it back to the basics. What's our job as a day trader? Our job, key job, our main reason, like when I wake up in the morning, my goal is to make money. But to make money, I have to be able to do a few things. I need to A, identify healthy opportunity, B, execute on this opportunity, and C, manage capital. Those are my three goals every single day. Identify opportunity, execute on the opportunity, and then manage the funds that protect us and keep us actually in the game, okay? So with that being said, let's dive into Monday. I want to break down trades and key takeaways from each day here, okay? So Monday was a really good day in the market, and this is what we wanted to see, right? Following last week's PA is we wanted to see more trending price, right? We wanted to see markets that are actually moving in one direction, right? Where the following weeks it's been insanely amounts of chop. It's just been terrible. Now we're starting to see a little bit more movement come back into the market. Monday, we took a setup. I took two setups, one on SPY, one on QQQ. My first long was right here. All right. So once again, using the number one tool that I've been using lately, which is the area of value. Okay. So the area of value is a very simple but very effective way to do that first goal of ours, which is identify a healthy opportunity. Because if I'm sitting in front of the computer and the market opens up, I have to be able to look at this and go, is there anything good here? Okay. Now, one of the ways I like to do this is by spotting an RBI or a GBI. This is an RBI because it's red. It's a red bar that was ignored or disrespected because it's high was disrespected, okay? So once again, red bar ignored. But I'm not necessarily just getting into the market. So previously, HPT has been trading a three-step approach for the last year, all right? The entry criteria would be an RBI or a GBI. Now, to do this, we have to be able to manage our risk, meaning our stop must go below the bar that was ignored. But in these current markets, we found it's, for me at least, it's been better to wait for price to come back into this zone. This is our area of value, okay? So as Monday price opened up, we got ourselves a red bar that was ignored. So now we have an area of value. It's called an area of value because this zone, this box, this is where the opportunity is hidden, okay? There's two things that can happen here. Buyers continue to defend this box, and then price has a very high chance of going up to previous day high, or sellers disrespect this box, maybe fall down below it, then the price will come back up to the box, followed by a GBI out of it. All right, so those are the two things that can happen when we identify one of these RBI'S or GBI'S. So I took the market long on the 1020 candle primarily because we were able to close back above the 9 double exponential moving average. Okay, so once again, if we're here to identify good opportunity, the way that we do this is by spotting the RBI or the GBI, drawing a box around it, and then figuring out who's defending that box by using our moving averages. That is my process. That's how I find opportunity. That's how I actually execute on the opportunity. And once I'm in this trade, I'm targeting the next upside target. Okay? So that was our first trade on SPY. And then our second trade was on QQQ or the NASDAQ, whatever one you're trading, whether it's options or futures. But this was beautiful. So what we loved about this trade, okay, and we took the market long on this candle, all right? And I want to talk about why. So once again, using our three-step approach, we've identified the red candle that's ignored. So we draw the box around it. This becomes the area of value. It's very important to be able to define these tools that we use, okay? It gives it more existence. It helps us know exactly what we're doing when we see it, helps us better execute on it. So here's our area of value. We're not going long right here, all right? We're staying patient. Wait, because what I found happening is when I went long right here, I was very far away, usually, from the 20 EMA. Now, anytime you're getting into a position and you're extended from a moving average, whether that's the 20 EMA, whether that's the 9 EMA, see, going back to the market, okay, the market doesn't care about our feelings. It doesn't care about our entries, doesn't care about our exits. The market operates based off its own principles, okay? Principles are basically inherent truths, okay? Things that repetitively happen, right? They consistently are happening, right? Those principles are anytime you're extended from a moving average, there's usually a pretty good chance we're going to come back to a moving average, okay? Supply and demand, that's another market principle, okay? So there's principles that the market is governed by. So when I was just going along, as soon as I got an RBI or GBI, what would happen is I would have to maintain some drawdown, wait for price to come back to a moving average, respect it, and then continue in the dominant direction. So now what we're doing is we're still identifying healthy opportunity using an RBI or a GBI, but now we're just waiting for price to come back into a moving average and respect it. Now, this moving average can be the 20 on the 5-minute. It could be the 20 on the 2-minute. It really doesn't matter, but the key takeaway is if the price cannot close outside of the 20, trade with the 20, okay? You guys see me do this on Fridays Live. Basically, anytime I'm getting ready to get into a position, I'm looking for a retracement to a moving average. When we come back to that moving average, I'm looking for it to either close outside of the moving average or stay within the moving average, closing inside the moving average. And when it closes, respecting the moving average, that's telling me that the trend is still aggressive, and in this case, buyers are still dominant, and I want to hop into the market long and make sure my stop is below that moving average. So that was exactly what we did here on QQQ, and we were able to capitalize on this beautiful move to the upside, all by using our area of value, our RBI or GBI. And what made this trade even better is this blue line right here. That's previous day high. So once again, critical level, moving average, RBI, GBI, okay? We're still using the same tools. It's like, it's not, the strategy doesn't work. No, you find different ways to use the tools that adhere to the principles of the market, all right? So that's how we were able to capitalize on that move there on QQQ. It was a really, really good move. Nice trending PA. So that was Monday's price action. Tuesdays. Look at this. Just like I just love how the market works. Up here we have supply. Down here we have demand. Okay? Soak this in. This is what we call a imbalance. Okay? The market has its own, like I was just saying, the market has its own principles or its own orders of operation, right? Market goes up, market goes down. But it gets a little more than that, okay? There's supply, there's demand, all right? Now, what you really want to start to realize is there's certain patterns we're going to see in between these, okay? So let's dive into Tuesday's price action. Tuesday, price opens up, comes right into previous day high, right here, sellers defend it. Now, once again, for me to get into a position, I'm looking for somebody to take advantage of the market, to become dominant, right? I want to see buyers or sellers take the ball. Now, it's our job to identify that healthy price action, right? That good opportunity. How do we do this? I'm watching open print, and then I want to see something go on with some moving averages. I don't want to marry and say you need a moving average cross, okay? Because it's not that binary, right? Nothing in life is that, black and white in the market's case. But I want to see some sort of moving average, whether it's a cross, whether it's respecting the 20, okay? I need some moving average play. In this case, we got ourselves a moving average cross. So now we get the green bar that's been disrespected. So once again, this is key area. This is an area of value. We have a GBI, okay? Green bar, disrespected, the low broke. This is telling us that there's trapped buyers here, okay? There's buyers that showed up and they're trapped. So we draw the box around the zone, all right? So now as price comes back into the zone, this is where I'm going to want to look for short entries, okay? My first trade I took was off the 2-minute 20. So if I pull up the 2-minute here and go to Tuesday right here. Okay, so once again, we have our area of value. We have price coming in to the 2-minute 20. All right. Now we took this trading futures, so this was a fast scalp. This was a quick move. Price comes into the 2-minute 20. Can't close outside the 20. It closed on the 20, but it lined up with my area of value. So I literally entered the market short right here, targeting the low. Okay. I trimmed one of my contracts here, and then I stomped out of my other contract on that candle. Okay. And that was a break-even stop, okay? So when you trade futures, we can do things like that, right? Keep our stops very tight because we could get back into the market, right? Now, if you look at this on the 5-minute chart, you'll notice something here. This area of value was never broken, okay? And once again, this is why this is my main tool here, because this chart is bearish until this area of value gets disrespected, right? We get a green bar ignored. Now remember, we're not going short here anymore, all right? That hasn't been working in these markets, so we stopped doing it. We're still collecting data on this approach, okay, because it's still beneficial. But what we're doing now is we're waiting for just a much cleaner entry. My first entry was here off the 2-minute, and now my second entry, I let price come into open print, come back down. I got myself a green bar right here that was ignored. So I entered in the market short right here. Okay, my stop loss goes right here. And then we target the downside target. This was an amazing, over 100% ROI trading SPX contracts here, following this simple RBI, GBI out of an area of value. This is what it looked like on the 2-minute. Okay, we entered on this candle right here. All right, so on the 2-minute, it looks something like this. Now, once again, just notice here, couldn't close outside the 20, trade with the 20. All right, that's our motto. If you can't close outside the 20, trade with the 20. All right, that was our short play. And then if I just were to draw RBI, our areas of value here on the 2-minute, just look at this. Just continuous retest of the AOVs. All right. Anytime you get a green bar ignored, you draw your box around it. All right. So that was a great day. Tuesday was phenomenal. Traded both my live account and the Top Step. And the biggest, once again, the biggest takeaway from Tuesday, guys, is just remember the polarity of the auction. All right, we up here we have supply, down here we have demand. This is why critical levels are so important. They have immense amounts of volume, right? There's buyers down here, there's large sellers up here. If sellers take control of price, there's a good chance we're going to see a move all the way down to demand, okay? Like, and how do we know? Like, what are we watching in between all that? For areas of value, for price to respect the 20, right? We want to trade with the 20 if and when we cannot close outside of it, all right? So just, following those simple principles of who's controlling the level, how do I know this, and how can I trade with them? What day is this? This is Wednesday. Really good day, Wednesday here. Once again, a little, hold on, let me pull up QQQ, because pretty sure, let me see. Wednesday, okay. Oh yeah, Wednesday was actually a little, not the, okay, so let's break it down. So first thing here, guys, what I want to point out is like the process, right? The process is, what is it? Every day our job is to find opportunity. So we get tons of selling here off the rip. I'm watching this, I'm going, well, give me an RBI, give me a GBI, okay? First one we get a green bar ignored right here. So what do? I draw my box, okay? So now I'm looking for some sort of opportunity coming out of this box, all right? Now, price comes into, once again, right? You want to be careful entering like spots right here. Why? Because we're far away from the 20, okay? Now, this one's kind of hard because we kind of came up to the 20. Not really, though. And then price finally comes up here and really retests the area of value. Can't close outside the area of value. Is this bullish? No. This is very bearish, okay? Anytime you get an AOV, and once again, it's being tested, but it's not closing outside of it, this is a key indicator that sellers still have the ball. Now we want to find opportunity. We want to find opportunity. I wanted to short right here, but I missed it. I was not in front of my computer. I wasn't watching it, so I missed it. And then I was like, damn, all right, that's frustrating because there's a GBI, a green bar ignored in an area of value. That's key. So I'm like, okay, let's get this one. I get a green bar right here, ignored. Josh, why didn't you go short? Because the 20. Okay, very far away from the 20 right there. So we let price come back into the area of value. We go short right here, and our stop goes right above this candle. Okay, boom. Price rips down, and then we get another GBI right here, and then this thing really just tanks. Okay, so moral of the story, right? Because looking at this, we're like, dude, a lot of selling. It's easy to look at this chart right now and go, yeah, okay, yeah, you shorted right there, cool. But what we need to remember is this is what the market looks like. We don't know if it's going down or up, all right? If anything, I was kind of convinced this was going to reverse only because the aggressiveness in selling here. But we didn't. Instead, I'm watching this. I'm going, okay, where's my RBI? Where's my GBI? Bam. 10-15 candle, green bar ignored. Okay, I'm not going short, but I'm going to use it as a guide, right? Like this is my guide. It's going to show me who has the ball. And then I want to see something happening off that 20, okay? 2-minute 20 is great too. Look at QQQ here, very similar price action. Green bar ignored right here. Can't close outside of it. Hold on, let me zoom in. Green bar, ignored. Price comes back into it. Coupled with the 20, we're getting another GBI. Coupled with the 20, boom, another GBI, another GBI. So,
bread and butter.
Yeah,
bread and butter right.
Todd knows. Those like RBI, GBI off the 20. Poof.
Yep. I took almost the exact same trade. I just took it on the 2-minute at 11:26.
Let me pull her up.
On your time?
On SPY or ES?
Yeah.
All right, let me see.
Yeah.
This guy, 11:26. Oh, yeah. Right there. Right there.
Yeah.
Right there. Same exact trade, bro. That's so clutch.
Yeah.
Todd, what was going through your mind? Break this down.
Well, I use a 9 and a 20.
Mm-hmm.
On the 2, we're below open print, so that means we're red on the day. So I'm only looking for shorts.
I like that.
So if I'm below open print, I'm looking for shorts. If I wear above open print, that means it's green on the day. I'm looking for longs. I'm trying to go with the trend.
Yeah.
The only thing I'm really looking for is 20 respect. And then, like I told you before, I got a 2 and a 5.
Yeah.
So say the 20. Say the 20. I don't know if somebody's on there. Say if I'm looking at the 20 on the 2 minute, and it doesn't respect.
Yeah.
Then I go to my 5. Now I go to my 5 minute 20 and see if I can get a GBI off of that.
Yeah.
The 2 minute, I mean, that's most of my trades come off of that.
And
I'm still bearish, even though if it breaks through the 2 minute 20, then I go to the 5 minute 20.
And I tell you right now, trading the prop firm futures helped me realize something massive. Options and futures are two completely different games, entirely. There's a lot of differences. The main difference is with futures, your risk has to be so small, like so tiny, right? Like you can, like what I found out trading futures is you take more trades, so your risk has to be extremely tight. One of the best ways to get surgically precise with your entries is that 2 minute 20, because when I'm entering short, let me see here if I could find even wasn't it would be on, let's look at, where's one right here. Okay, say we come up, okay, like right here, you guys see this candle, this green candle wicks above the 2 minute 20 but can't close above it. That's a short play, and it's coming out of an area of value. Okay, so if we're in an area of value and we can't close outside that 20, I'm getting in short primarily because my risk can go right here. I'm risking four points here. I think that's how they say it, like 4 ticks, 1 point. I'm risking 1 point on this trade. So I can now enter in with 2 contracts on a futures or 3 contracts and only risk $200. Right? So that's been really beneficial for me. Now, if I'm trading options and I could get less risk, why wouldn't I? You know what I'm saying? Like, I mean, in options, there's a little more leeway, right? You could probably have a whole 5 minute candle, but with futures, a 5 minute candle drawdown is going to cost you way too much money. I mean, sometimes that might work. But other times you're going to want to stay away from that. Now, going into Thursday, I did not trade that well. Thursday, I only traded my Top Step account. Took just a bunch of wishy-washy trades. Let's break it down. So basically, my first long... So I made a mistake on Thursday where I kind of forced an entry off the 4 minute. Because nothing else was available. Now, I want to go back to what our primary goal is as day traders. Number 1 is to identify good opportunity, right? Now, that doesn't mean create good opportunity. That means identify it, meaning it's there. You're not conjuring it up in your mind, okay? Now, we follow these rules, principles, and guidelines for a reason, right? The open print, the critical levels, the moving averages, the RBI'S, GBI'S, like on the 5 minute. 4 minutes good too, but one thing I want to point out is the same principle we use on moving averages, meaning if it's respecting the 20, trade with the 20. If it's respecting the 20, don't trade off the 50. You see what I'm saying? Like, stick to the one that's being respected. Now, same goes for time frames, because some days you're going to find great opportunity on the 4 minute. Other days you're going to find great opportunity on the 5. But what I recommend is use the one that's working that day, okay? Don't just watch the 5, notice there's nothing, so drop down to the 4, all right? Because this is where I went long. I identified this red bar right here, ignored. So now price came back in, and I took a long play right here, okay? Just playing off the area of value and wanting to keep my stop close to open print. Now, what am I not doing here? I'm not playing off the 20. I'm playing a random bounce off a area of value. So if I'm going to do that, my stop has to go here, and I can't assume it's going to continue. And it didn't continue. I ended up getting out of this trade right around break even because I realized what I was doing, and I was like, this isn't worth it. It's not worth the $200 in risk. I'll just get out of it. And what happened, we ended up turning around. Now, what I did next is I identified this little green bar that was ignored. So when price came into this zone, I entered short, and I caught a nice little short play down here. But once again, I'm not really sticking to the moving average cross. I'm trading unhealthy price action here. I'm just trying to make money. That is what was wrong with my mindset on Thursday. I was trading for the money. I wasn't trading the process. I was just trading any area of value, and I was trading any time frame that worked. I was catching some. Go ahead, Todd.
A flat 20.
Yes, the flat 20.
Flat 20 is no good.
Mama always said never trade the flat 20. I 100% agree, because this is sort of stuff you're going to get. There's no trend here. I was still able to get some good plays here. I got a good short play right here using the area of value. But then I went full retard and sized up towards the end of the day and played a long play that had no follow through. But if I stuck to the principle of keeping my stop below the area of value, this trade would have worked. But since I sized up, I was more vulnerable, and I ended up taking a much larger loss than intended. Now, let's go to Tuesday or Friday, because Friday, I want to talk about that price action, but then I want to talk about this Tesla trade that we absolutely crushed. So, market opens up here on Friday. I mean, once again, we're not getting anything good. I want to point out here, though, Todd, I think you took this trade too. Look at how price can't close outside the 20, and we get follow through. Okay, but if you're trading this way, don't put your entry long right here. Okay, don't go, oh, it respected the 20, and then wait for an RBI, because now you're far away from the 20. If you're trading off the 20, keep your entries as close to the 20 as possible. This is going to increase how much money you're making, but more importantly, decrease how much you're risking. I can't say it enough. Risk is so damn important, and we've learned this these past couple weeks, especially when you got to go 2 weeks without making any money or 3 weeks without making it, just breaking even. So I took a short play right here, couldn't close outside the 20. I entered in short literally right here, and my stop was right here. I added onto the position right here, and we caught a nice little move down to EOD. Nothing crazy, and like $300, $200. And then we shut down the live because price action was garbage. Once I shut off the live, which is typical, price action on Tesla started to heat up here. Now, I want to point something out here. The simple principle, once again, price comes into the 20, can't close below it. I don't enter here, I enter here on the long play, okay? Because look where the 1 hour 9 is, okay? We got the moving average cross. So now I want to keep my edge, I want to keep my entry close to the 20 EMA. Capture a really good long play right here. Okay, cool. 80% ROI on that trade. Now, here's what I really want to talk about. Look at the area of value following the red bar that was ignored. Okay? Price comes back into the area of value. Guys, can't close outside the 20. This is a long entry with very tight risk. Beautiful move to the upside. And you know everybody and their mother was shorting this because it was below open print. It was starting to shift. But look at how it respected the area of value.